12年快乐! Looking into 2025, what can we expect from the markets? Vasu, what is your take on that?
Now, looking back at 2024, investment markets staged a mixed performance. Global equities based on the MSCI All-Country Global Index posted a gain of 16% in US dollar terms. In terms of geographical breakdown, US equities was the star performer, posting a gain of 23%. Now, elsewhere, Chinese and Indian equities also did well with strong gains of 16% and 11% respectively. Other markets in Asia that did well based on the MSCI indices included Taiwan, Singapore, and Malaysia. Overall, equities in Asia ex-Japan region posted a gain of 10%, which was very decent. The performance from other major regions like Japan and Europe were less spectacular. Japanese equities posted a gain of about 6%, but European equities were down modestly by about 1%. In terms of equity sectors, the tech sector was clearly the star performer. The financial sector also did well. As for global bonds, they did not do as well as equities. Still, bond markets attracted decent inflows in 2024 as investors continued their search for yield. Gold did very well last year. It posted a spectacular gain of 27%, which was one of the biggest annual gains in this century. The precious metal benefited from the backdrop of several global uncertainties and aggressive buying by major central banks. Now, looking ahead into 2025, we see a world navigating profound changes. President Trump's return to the White House is setting the stage for significant shifts in the global geopolitical and economic landscape. This calls for investors to be nimble and to capitalize on opportunities that may emerge from time to time. Keeping a diversified portfolio is especially important in 2025 to hedge against uncertainties and geopolitical risks. Markets may not move up in a straight line in 2025. Brace for greater volatility, but do not lose hope if markets see intermittent pullbacks. The current bull market in global equities started about 2 years ago. During this period, we saw several episodes of market turbulence. However, markets regained their footing and went on to scale new heights. So, for those who kept faith and stayed invested, they were rewarded. In other words, it is normal to see volatility in a bull market, and investors should not get spooked by it. Now, in 2025, Trump's pro-growth and pro-business agenda may boost the US economy and equity markets. However, for the rest of the world, a second Trump term may prove challenging given the risk of steeper US Treasury yields and a stronger US dollar. There's also the risk that Trump's budget and immigration policies may fuel inflation in the US. If this happens, it may complicate the outlook for US monetary policy and stop the US Federal Reserve from cutting interest rates or perhaps even slow down the pace of rate cuts. Asia ex-Japan markets have come under some pressure with Trump's victory. However, the region's more favorable valuations versus the US stock market means that investors should continue to maintain exposure to Asian equities and not throw all their eggs into US equities. The possibility of extraordinary stimulus from China in 2025 is another factor that may augur well for Asian markets. So the medium-term prospects for Asia are still very promising. Despite the challenges ahead, we remain sanguine on equities as an asset class and we continue to see opportunities in the horizon. We are overweight US and Asia ex-Japan equities and neutral Japanese and European equities. If the economy and earnings continue to deliver, stock markets have more upside in the medium term. Now, the ample liquidity on the sidelines is also supportive of markets. While we are positive on equities, we are more cautious on bonds. Still, medium-term opportunities can be found in bond markets. Keeping a diversified portfolio is especially important in 2025 to hedge against uncertainties and geopolitical risks. Overall, the medium-term investment outlook seems promising. Navigate volatile markets like a fish in water. Be confident and look out for opportunities.
Wow! 如鱼得水. Chinese stocks ended their two-year losing streak in 2024, supported by policy support measures introduced since last September. However, the positive sentiment waned around the new year as investors grow impatient with lack of detailed follow-through despite the verbal assurance from the December Central Work Economic Conference for more policy support. China is likely to close 2024 by achieving its growth target around 5%, but notable disparities in the past year have highlighted underlying challenges for the economy. Firstly, there is a disparity between economic recovery and public sentiment. While economic indicators demonstrate a V-shaped recovery in 2024, public sentiment remained cautious. So my personal trip to the Tier 1 cities in the last week of 2024 revealed persistent concern about the weak income expectations and job security. Secondly, there is a disparity between property market stabilization and weak retail sales in the Tier 1 cities. Resale property prices in the Tier 1 cities increased month on month for the second consecutive month in November. In contrast, retail sales in cities like Beijing and Shanghai declined sharply, falling by 14.1% year-on-year and 13.5% year-on-year respectively in November. So this divergence highlights the widening income gap. Thirdly, there is a disparity between the deflationary pressure and reflation measures. So despite the market urgency to combat the deflation, China's actions to reflate the economy fell short of expectations. In September, the central bank governor signaled a potential 25 to 50 basis points triple cut before the year end, following a 50 basis points cut in September. However, this did not materialize, even as inflation data remained quite subdued in October and November. Despite these gaps between the expectation and reality, China's intention to reflate the economy appears intact. So we anticipate more measures to be rolled out in 2025. So there are three notable shifts in the policy tones for 2025. Firstly, the monetary policy stance will shift to being moderately loose, marking a significant departure from the prudent monetary policy regime in place since 2011. So we expect the PBOC will lower the one-year loan prime rate by 40 basis points in 2025. So meanwhile, we also expect China to further cut the triple R by additional 100 basis points. Secondly, fiscal policy will become more proactive, signaling intensification from the current proactive fiscal policy. So we expect the fiscal deficit target for 2025 to increase to about 4%. Well, this will increase additional fiscal spending by about 1.3 to 1.5 trillion yuan. Additionally, the issuance of the local government special bonds and the long-term special bonds is likely to expand. Thirdly, for the first time, policy language including the term extraordinary to describe what we call the counter-cyclical measures. So this opens the door for the potential large-scale intervention such as the stabilization fund for both property and equity markets. So this will set the floor for the Chinese equities in our view. So overall, we still believe China is in this we call the whatever it takes mentality coming into support for the growth in 2025. On the US-China relations, there are both knowns and unknowns. The known is that the higher tariff is almost certainty, but the unknown is centered around the implementation of these tariffs. China's reaction in the Trade War 2.0 could be different as compared to Trade War 1.0. So to prepare for a war, you either target your opponent's intention or capacity to launch the war. So during the Trade War 1.0, China adopted a trading time for space strategy, offering the concessions to mitigate Trump's intention. However, in the Trade War 2.0, with a clear willingness to employ tariffs, this approach may no longer be effective. Instead, China may target Trump's capacity to wage a prolonged trade war, with the US inflation being a good target. So we believe China's response could focus on two key areas, including number one, expanding the domestic demand, number two, reducing the subsidies for the overseas consumers. So in the near term, targeting a US inflation could prove to be an effective countermeasures. By exporting inflation, China could directly impact the US consumers and business, applying political and economic pressure on the Trump administration. So this means less subsidy for the overseas consumers. So a stable renminbi might better serve China's interests in the Trade War 2.0 by preserving its ability to export the inflation while minimizing the domestic economic disruptions. Nevertheless, these prospects for exporting inflation may trigger the global ripple effects, intensifying the challenges for other economies as well as increasing the market volatility. Market will face lots of uncertainty in 2025. There will be lots of opportunities regardless of market condition. Just like this pot, gathering lots of treasure in one place.
Wow, then you should eat more 鲍鱼，报你富贵有余。
恭喜发财!
Equities performed well in 2024 and most markets ended the year on a positive note. Optimism was driven by several key factors, and obviously one of the key factors was AI-driven investment teams. And over and top of that, actually corporate earnings came in better than expected, and that is despite the fact that there were pockets of geopolitical tension as well as economic uncertainties in the world. Singapore did well, of course, and then in terms of both the economic growth and also in terms of the stock market gains. Last year, we started the year by sharing about the fact that it will be a year of election, and one of the key elections to watch out for was the US presidential election. And no surprises here, Donald Trump has been re-elected for a second term and this is going to be a key factor to watch out for in 2025. Based on Trump 1.0, I like to term Trump 2.0 as the triple T: Trump, trade, and tariff. During Trump 1.0, if you recall, analysts were kept very busy because of the fact that there was constant update about trade wars, tariffs, etc., and the to and fro, and that actually caused a lot of market volatility. And we expect that to also again happen in Trump 2.0. Remember, during his pre-election campaign, he talked about tariffs on certain countries, including China and even Canada. And if this takes place, it could mean there will be another 3 to 4 years of market volatility. In particular, we think that tariffs is going to be a real issue, especially with companies within the region. Actually, if you look at Singapore companies in particular, recent market sentiment actually shows that businesses are actually quite positive about the outlook for 2025. But they did share that one of the key concerns is the fact that going to 2025 and with the policy changes ahead, they are worried that this could possibly have an impact on earnings as well as on their general expansion. Another key thing that we'll talk about is, of course, on interest rate. Recall about a couple of months ago, we're talking about close to almost 5 cuts for 2025. But now we're looking at less than 2 cuts. What this all means is that interest rate will stay elevated for a long period of time. So overall, we're talking about 2025, Singapore growth will be close to about 1 to 3% based on government official forecast. But if you look at private sector economists, they're looking at about 2.7. So Singapore economy is still going to be fairly healthy in 2025. Then what will drive the stock market then? One of the key things is, of course, to look at the earnings. So if you look at earnings, in terms of corporate earnings for US, I think they're going to do very well, largely because of the fact that US companies will benefit from some of the policy that Trump will introduce, and that will include most likely very favorable taxes as well. So on that basis, S&P 500 is going to report very strong double-digit earnings growth in 2025 and 2026. But here in Singapore, where we have a more core group of very stable, well-established company, we're talking about earnings growth of about maybe close to 2.4% in 2025 and then about 4.8% in 2026. So as a measurement, if you take a look at price to earnings as well as price to book, on a 10-year basis, both indicators are actually trading below the historical 10-year averages. And this is despite the fact that 2024, the year, actually the STI did very well, and it was now hovering close to 2008. So while the STI is high, it doesn't mean the valuations are high. In fact, valuations are actually quite attractive and lower the 10-year historical level. Another key sweetener is the fact that Singapore stocks actually on average, if you're talking about STI 30 stocks, the dividend yield is almost close to 5%. So you take a look at the sectors then. Banks did very well last year. In fact, it was a clear outperformer. Banks did well in terms of share price as well as in terms of record profits. The record profits came because of the fact that actually interest margin was very high last year, and that actually also resulted in a very good profit for all the banks. But more importantly, banks actually dish out a very good dividend last year. So we have a bumper crop of dividends, and that in a sense had provided a support for the banking stocks. So overall, we remain overweight on the Singapore banking sector. We'll move on to the property sector then. If you look at REITs in particular, REITs have actually underperformed quite badly in 2024. This poor performance was largely because of a high interest rate environment, which of course does not favor the REITs. Having said that, if you take a look at the current dividend yield, then it's almost close to 6%. So this already discounted the fact that actually the interest rate will stay high. But if you take a look at 6% versus 3% that you can get from about T-bills, then there's a differential of about 3%, which still makes it quite attractive. Our preference is for REITs which are bigger, because we believe that bigger REITs will be in a much stronger position going to 2025 and 2026. So overall, if you look at 2024, STI was up about 17%, but just forget the fact that there is a dividend yield of almost close to 5%. And if you add a 5% to a 17%, we're talking about total return of almost 22%. A lot of markets participants do not look at total return, but we think the total return is very important because that gives you a better idea of how the market has performed. Overall, we continue to have an overweight on the Singapore market, especially as we head into 2025, which we believe will be a very volatile year, especially with the policy changes and also the geopolitical tension remaining as it is. Singapore's very stable core group of companies will be a very interesting diversifier to any portfolio, and we continue to have an overweight on the Singapore market.
Come on, let's not wait further. Let's go for the Tuzo for sign of prosperity and wealth. The S&P 500 index saw a strong gain of 24% for the year 2024. And for that, it pushed the index price to earning and price to book ratio above the 10-year averages. And that also implied to a standard deviation. However, the strong gain may indicate that price could face some price volatility in the early months of 2025 as the market digests its strong gains. The main drivers for the strong performance in 2024 has been the expanding field of AI, semicon related, and also not forgetting the financial services sector. Leveraging on the market momentum of this sector itself, the market may potentially see this sector continuing their rhythm into 2025. On the AI front, the research shared that the global semicon market is projected growth 4.7 times, reaching around $230 billion by 2034. This translates to a compound annual growth rate of 15% from 2024 to 2024. And this indicates significant expansion of the semicon industry that is expected to continue into 2025. Looking ahead, there are several factors that could influence the S&P 500. Supportive policy from the Trump administration and also a resilient US economy may favor the equities market that is backed by earning growth driving the returns. Potential positive for the US stock could also include legislative deregulation, the extension of the tax cut, and also the lower of the corporate tax rate. On the downside, geopolitical tensions and rising inflation from the increased tariff could also pose a challenge to the market. High valuations and the concentration of the Magnificent Seven companies also highlight the need for diversification to manage your risk portfolio. Now, let me share another very interesting market, that is the China and Hong Kong market. While Donald Trump's potential trade tariff may negatively affect the Asian equities market, but do note countries seem to be more prepared this time around with countermeasures than they were before during his last term. On the fundamental aspect, the current Hang Seng Index price earning as well as its price to book ratio itself are trading below the 10-year averages, and interestingly, the Hang Seng market dividend yield at 3.8% is traded above the 10 years averages. On the corporate scene, more Chinese companies are paying dividends. By the end of the fourth quarter of 2024, they pay out about $16 billion in dividends. That is a 47% increase from the previous year. And also, the interim dividends for the coming first quarter of 2025 are expected to reach about $13 billion. If that ever happens, that will also be another record amount. This will include special dividends and interim dividends plans that have been announced by all these companies. Talking about share buyback, almost 2,200 of the Chinese listed firms have carried out shares buyback worth $22 billion in 2024, thanks to the supportive policy from the PRC government. This is a record number that is over 30% more than in 2023. The China and Hong Kong markets are expected to see stabilization in the price level. Companies that focus on the domestic market and high-quality yield stock may help to reduce price volatility, especially those benefiting from the supportive policy. On the other hand, exporters that rely mainly on US sales are not as favored right now. The investment strategy emphasizes an overweight position in US and Asia ex-Japan equities, especially in China, Hong Kong, India, Indonesia, and Singapore, despite tariff challenges. The technology sector is poised for growth, fueled by the AI boom and strong earnings from the major tech companies that are expected to continue their momentum into 2025. In China, large-cap internet companies may benefit from domestic stimulus supported by favorable valuations. The current market trends are benefiting the consumer discretionary, consumer staple, and also the healthcare sector. This is due to expectation that Trump's tax cut will bring forward a more positive impact on the business and consumer spending, especially towards the consumer discretionary sector. While some retail stock may and might be affected by the trade tariff itself, but do take note, this cost may be passed on to the consumers. We are taking a cautious approach to the fixed income as we expect longer-term interest rates like the 10 and 30-year rates to move up. That will steepen the yield curve. The new Trump administration policies may boost growth and inflation, leading to higher treasury yields and possible fiscal deficit. Despite this, bonds are still important for diversifying investment and protecting against market volatility. Currently, the market favors bonds with a shorter duration of 3 to 7 years because their yields are simply more appealing. As for the China and Hong Kong market, it may take time for earnings to improve, but there is hope for growth if further fiscal policy supporting measures are being introduced soon. Recently, policymakers mentioned plans for supportive policies in 2025, like increasing the fiscal deficit and boosting domestic consumptions. This action could lead to market rally driven by earnings along the anticipated economy recovery. In conclusion, the US stock may experience a period of price consolidations, but the long-term outlook remains positive. Investors may want to consider buying on dips to take advantage of potential future growth and improve returns. Maintain a consistent investment strategy with a focus on the medium term. Ensure your portfolio is well diversified to mitigate potential risks and global uncertainties.
大吉大利，吉祥如意，来换啦！